Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The Reserve Bank Board is widely tipped to reduce the official cash rate today for the first time since late 2020. If rates do drop, it'll be welcome news for many homeowners. But how much will they actually save? And what would a cut do to the broader property market? Tim Lawless is the head of research for CoreLogic. Tim, welcome back to Fear and Greed.
G'day, Sean. Thanks again for the invitation.
So first up, do you think they'll cut rates this afternoon, or are you that single person out there that doesn't think that?
I am in the February camp, but
right.
Qualifying, of course, that no guarantees. So I think the RBA will cut, and if they don't on their February meeting, then almost guaranteed it's an April one, right? So I think the timing is almost becoming irrelevant because most pundits really seem to be pricing this in anyway. It really does seem to be that the rate cut is on the cards, and the timing's the only uncertainty.
Okay, so just in round numbers, so someone paying a mortgage, for example, be it a $500,000, $1 million, $700,000 loan, whatever you think, what does a 25 basis point cut do?
Yeah, not too much. So
Tim, we need more than that. We need more than that. We need excitement here.
Yeah, it's a start, put it that way. And I think the biggest benefit from a rate cut is really going to be about the sentiment injection we get from it. But here's some numbers. So if you're on a $750,000 loan and you're an owner-occupier, you're probably on a mortgage rate around about 6.33%. 25 basis point cut means you get down to about 6.08, almost guaranteed the banks will pass it on, which means you're saving around about $122 a month. So to put that into broader numbers, at the moment, you're probably paying somewhere like about $4,657 a month on your mortgage. A rate cut means you're still paying $4,535 a month. So it's small bickies in the grand scheme of things, but of course, $121 a month, that's okay. It's better than going up or staying flat. But like I said, I think the biggest benefit from a rate cut is going to be just an improvement in sentiment. And I think we've already started to see consumers feeling a little bit more confident about their finances amid an expectation that the rates are coming down.
How many rate cuts do you expect to see this cycle?
There's a lot of people who are much better placed to answer that than me for sure, but I'd be expecting 2 to 3 rate cuts this year, so probably 50 to 75 basis points. I think overall this is going to be quite a cautious and gradual cutting cycle from relatively high levels. If you think about the 10-year average for the cash rate pre-pandemic, it was about 2.55%. So we've got a long way to go before we're getting anywhere near that pre-pandemic average.
Where's neutral for interest rates? Where do we get to where we think that it's not really adding much to the economy, not taking much away? I know that yesterday the boss of Bendigo and Adelaide Bank kind of said, well, for 3.50 cash rate, that's about 80 basis points below where we are now, is about neutral. Does that sound right?
It sounds about right to me. 80 to 100 basis points down, I think would certainly add a bit of an injection to the economy and to activity without overstimulating the market. And I think, even if we did see rates coming down a little bit more aggressively than what I'm expecting, I kind of feel like the housing market potentially would be a little bit insulated from that, because I think if the RBA and APRA started to see households becoming a little bit more exuberant and taking on debt, that's where they could start to lock down prudential policies as well. So, credit policy is completely different from cash rate settings. Like we saw through the previous periods of macroprudential, that was December 2014 and March of 17, that had a really clear dampening effect on the housing market. So that's probably another one to watch, would be what happens with credit policy. There's still some speculation we could see the 3 percentage point buffer applied by APRA reduced back to 2.5 maybe, but I'm a bit skeptical of that. I think that they'll probably be acting quite conservative and just trying to keep a lid on household debt levels where they can.
Without getting too technical on this, because we need to go to a break in a moment, do you think APRA would get tougher in prudential standards, so actually make it more difficult for people to get a loan?
Only if we saw household debt levels becoming higher than what they currently are. So we are seeing household debt levels have come back a little bit. They're back to roughly about 2018 levels, but that's still actually really high. We're looking at household debt levels to income ratios around about 180%, right? So we still have a quite a heavily indebted household sector, and most of that debt is housing related debt. So I don't think we'd see APRA tightening things up unless we started to see household debt levels becoming higher than what we're seeing already.
Okay, I want to talk about how the market's tracking, auction clearance rates, all sorts of things, but we'll take a break first. We'll be back in a moment. I'm talking to Tim Lawless from CoreLogic. Let's get to house prices. How's 2025 started, Tim?
Relatively soft, Sean. So
Ouch.
last month
You've been a bit grumpy this whole interview. We
Man,
started about the
such a
interest
pessimist.
rates, and now you're telling us the house prices are soft. Go on.
Well, it's probably a good thing for a lot of people that have been looking to get into the market. We've come out of this roughly 14.5% cycle of growth over the past roughly 2 years. And now we've seen about 3 months where housing values have drifted a little bit lower. They're down like 0.3% from their peak back in October. So I wouldn't say the market's crashing, but we have seen some markets falling a little bit more steadily. Melbourne, for example, is seeing values about 7% down from the peak back in 2022. Hobart's down a bit more than 12%. Sydney's now seeing falling values from month to month as well, down nearly 2%. And we're seeing momentum coming out of the mid-sized capitals as well. So the very strong markets of Perth, Adelaide, Brisbane, still rising pretty quickly, but nowhere near as rapidly as they were, say, 6 months ago.
How do these markets work? We always talk about house prices always going up, and those of us that live in one of the very big cities, we talk about the affordability for kids and all that sort of thing. But do markets go up and then go down, but not fall as much, and then go up further, then go down a little bit? Or do they, I mean, that seems Melbourne, for example, whereas Sydney doesn't ever seem, excluding COVID, doesn't ever seem to fall that much?
Well, no, there's definitely periods of cyclical downturns. I mean, Sydney is a good example where just think back between the middle of 2017 and the middle of 2019, we saw Sydney home values fall a bit more than 10%. And that was after a pretty decent growth cycle. And again, that was, remember, amid the Royal Commission and credit tightening events, and of course, affordability challenges as well. Or a market like Perth, where we saw housing values fall nearly 20% after the mining boom. So definitely we do see housing prices come down. But I think your analogy of they rise and then they fall a little bit, then they rise again is very true. Generally throughout the cycles, we do see overall growth over a long period of time. You look at, say, just the last 5 years, we've seen housing values across Australia are up around 30 to 35%. Some markets are up more than 70%. So, I think we've come out of a very strong period of growth, but there's other examples of Melbourne or Hobart where absolutely, even with very low interest rates during the pandemic, those markets, particularly Melbourne, were still generally quite weak.
Where are we on affordability at the moment?
Again, it's pretty diverse. If you look at the national numbers, our affordability metrics are up to September at the moment because the income data takes a bit of a lag to come through. But we're at record highs for pretty much every measure of affordability. So there's a lot of different ways to measure affordability. You can look at things like dwelling values relative to household incomes, or how much income are you paying towards mortgage repayments, or how long does it take to save for a deposit? How much income are you dedicating to rent? Each of those measures were at record highs nationally, but some markets had improved. Again, Melbourne being quite weak, or Hobart. We've actually seen Melbourne really moving through the affordability league tables in all the right ways. It's now the most affordable market after Darwin and Hobart when you adjust for incomes, whereas a market like Brisbane has now got the second highest median value and it's really marched up through the tables, or Adelaide is the second most unaffordable city when you adjust for incomes, just after Sydney. So, affordability is really stretched in some markets. And I think, Sydney is just it is a little bit hard to understand how we saw values rise so much in Sydney when you have dwelling value to income ratios that are up around 10 to 12 times. So it is a little bit difficult to understand, and we generally would attribute that strength in conditions when you have such unaffordable stock simply back to very low supply levels, which still look to be broken.
Okay, before we go, a moment of voyeurism. A Melbourne property last week, reportedly 150 million, but that is reportedly. It certainly sold for a lot of money, Kunak, in Toorak. Does that mean anything, or is it just us enjoying rich people buy big houses?
Yeah, it's certainly interesting, and it hit the headlines. Everyone's interested in that sort of sale, but it doesn't mean anything to normal people like you and I. So I think when you look at really unique high-end properties like that, they're very niche. It doesn't really tell us anything about what the market's doing, and they're almost impossible to estimate what the value might be for when it does sell. Interesting to read, and everyone sort of shakes their head at the height of that sale, but it doesn't really mean anything for the market.
Tim, thank you for joining us today on Fear and Greed.
Many thanks.
That's Tim Lawless, Head of Research at CoreLogic. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.